Good morning, Bitcoiners. A very happy new year to you all, and welcome back to your economic calendar with the information you need to start the week off right in Bitcoin. As always, I'm your host, Mauricio Di Bartolomeo here at Ledn, and today is Tuesday, January 3rd. Now, this is the first show of 2023, and we have a special one for you today. The end of each year is a time when typically people like to reflect, and investors like to reflect on their portfolio performance. It's not surprising that many investors look to make changes to their portfolios at the start of every new year. And when a great group of people collectively try to make a change or act on something at the same period of time, this can create what's called seasonal effects, which are behaviors or patterns that tend to repeat themselves over time in particular periods. Now, in today's issue, we're going to look at three of those issues in Bitcoin, which is seasonality effects on the change of every year, seasonality effects on the change of every month, and we're also going to look at how tax season impacts Bitcoin. So, without further ado, let's go into today's show. And before we get going with today's analysis, let's take a quick look at how Bitcoin traded for the last week of the year. We see here that last week Bitcoin traded still within that very narrow range, dropping just 1.29% at 16,611. We see that it is currently trading very close to that level, and we are going to get into some of the near-term catalysts for Bitcoin's potential next move in today's issue. But with that, let's get going with today's analysis. So as I mentioned at the beginning, new years bring new beginnings and seasonality effects. Because tax calculations and other reporting requirements happen on an annual basis, the turn of each year typically exposes a few seasonality effects that can and typically impact price. And a good example of this is what's called tax loss harvesting. And let's pull up a article here to make reference to this point. Now, an example of tax loss harvesting is when investors sell an asset that has performed poorly during the calendar year at the end of that year in order to book the capital loss and offset gains in other parts of their portfolio for that same calendar year. This tax treatment also applies to Bitcoin, and this is exactly what Michael Saylor and MicroStrategy did last week. This is the article on your screen right now that highlights here this tax loss harvesting piece. We'll get into that in a second. Now, let's use this transaction as an example to show how this works. MicroStrategy has been buying Bitcoin over the last few years, and so far it has acquired 132,500 Bitcoins at an average price of around 30,397 per Bitcoin. Now, by selling 704 Bitcoin at 16,761, which is exactly what Mr. Saylor did, it creates a taxable loss of $9.6 million, which is no more than just the difference between the average purchase price, 30,397, minus the selling price, 16,761, times the number of Bitcoin, times 704. Now, this credit can be used potentially to offset previous or future capital gains. And this benefit doesn't only apply to MicroStrategy. You can be certain that other US investors were also tax harvest selling some Bitcoin sometime in December. Now, tax harvesting is only one of the many seasonal effects in markets. Another one is calendar year seasonality. And the chart we're going to show you next shows Bitcoin's historical price changes by month. We're going into that just now. And the chart on your screen shows the median absolute percentage change by month for Bitcoin going back to inception. Disregard this 1928 date, as this is used to pull that same data from other traditional finance exchanges. So Bitcoin will be from 2009 to date. So as you can see from the chart, January is the month with the biggest price changes on average. And this type of seasonality could be attributed to many factors, including tax loss harvesting lags and portfolio rebalancing at the start of each year. Now, regardless, January has historically been a month of big movements in Bitcoin price. We also see big moves in June, which marks the 6-month mark each year, and November, which again could mark the start of tax selling season. So again, it's interesting to see here that the biggest spikes or the biggest months where volatility historically pops for Bitcoin are the start of the year, the middle of the year, and pretty much the end of the year here in November, which makes sense because these are the points in time in which a lot of investors would be looking to reflect and potentially make changes on their portfolios. Now, Next, we're going to look at the turn of the month effect. And this is a trading strategy that calculates the performance of buying Bitcoin on the 5th last trading day of each month and selling the Bitcoin on the 3rd trading day of the new month. And for that, we're going to pop up a new chart. And here is the chart on your screen. The graph that you see is simply the aggregate returns of running this strategy, as I mentioned, which are the buying Bitcoin on the 5th last trading day of each month and selling it on the 3rd trading day of the new month. So as you can see from this chart, this strategy would have returned a compound annual growth rate of 51.3%, which is this number right here. And it would have had a maximum drawdown of negative 38%, meaning that is the maximum potential loss of this strategy over the history of Bitcoin. Now, comparatively, just buying and holding Bitcoin during the same period returned 94.2% annually on average. However, the interesting thing here is that the max drawdown of buying and holding was a big negative 83%. So the interesting thing here is that if you get the upside drawdown ratio of this particular strategy, you get that it's 1.35%. If you divide 51.3 by negative 38% or 38%, you get 1.35. Whereas if you divide 94.2% by this 83, you get a return to drawdown ratio of 1.13. And which goes to show that this strategy would basically perform slightly better than buying and holding based on this backtesting data. Now, potential reasons for this turn of the month phenomenon could be the following. 1, the aggregate effect of monthly dollar cost averaging. As most people get their paychecks typically at the start of each month or at the end of the previous month, the aggregate effect of thousands of small orders of people buying Bitcoin in small increments could provide a tailwind for Bitcoin at the start of each month. Now, the second reason could be that at a corporate or institutional level, portfolio decisions are typically made on a monthly or quarterly basis. And with so many institutions getting into Bitcoin during this sample period, the aggregate effect of institutions deciding to enter positions at the start of every month or quarter could also reinforce this effect and provide a rationale for this phenomenon. So now let's take a look at some other effects. Now, seasonality aside, macroeconomic indicators still point to lower inflation and a deteriorating economy in the US. The US consumer's balance sheet is also quickly deteriorating. The housing market is starting to roll over, and all of this suggests that there could be further weakness in asset prices in general, and we're going to cover more in this in more depth in our S&P 500 section, which you can read in our blog, link below. Now, outside of seasonality and volatility, there was another event that created headlines within the Bitcoin community, and we're going to pop that up right now. Now, this event or piece of news was that Luke Dash Jr., a prominent Bitcoin Core developer, tweeted last week that his self-custodied Bitcoin hot wallet had been compromised, and over 200 Bitcoins, equivalent to about $3.6 million, had been drained. And this is the article you have on your screen that makes reference to this. Now, while the recent events surrounding the FTX fraud and bankruptcy showed that there are risks associated with using custodial services, the fact that even a Bitcoin Core contributor had his self-custody wallet keys compromised highlights that there is no one-size-fits-all solution to storing your Bitcoin. Now, people have different skills and preferences, and our industry should be focused on solutions for everybody in that spectrum. At Ledn, we encourage clients to have a diversified portfolio and learn about self-custody while also providing a suite of services like savings accounts and loans for those who can benefit from them. So more details on the blog. We have the S&P section, DeFi, gold, and mining. And now we're going to get into what you can expect for the week ahead. It is the first trading week of the year. And as we covered in our S&P 500 section, this has historically been a volatile week for markets. Now, in terms of economic data, the minutes from the Fed's last FOMC meeting will be released this Wednesday, and markets could react to that. We already know that the Fed wants to raise rates a bit higher and keep them high for the rest of the year. But any additional detail around their collective or individual views could generate headlines. We will also get a new read at US job openings, which are expected to show a slight reduction. But even at these levels, the data shows that there are about 2 job openings per every unemployed American. It is trending in the right direction as these extra jobs are coming off the table. And given where macroeconomic indicators are, it would not be surprising to see these job openings collapse in the near future. Expect more headlines around US labor markets and unemployment in the near future. Now, in the crypto world, the Genesis restructuring talks are not going great. And here is an article we wanted to pop on this front. The pressure has been building for Gemini as clients of their Earn product, who collectively have a $900 million claim, started a class action lawsuit against the exchange's founders, the Winklevoss, which are known or who are known billionaires. And here is the article on your screen making reference to that. Now, the Winklevoss are now transferring that pressure over to Genesis. Yesterday, Cameron Winklevoss published an open letter on Twitter addressed to Barry Silbert, who is the CEO and founder of DCG, which is Genesis Capital's parent company. And here is that article for your reference. Now, Mr. Silbert responded to the letter via a comment on Twitter. And Mr. Silbert, in the same tweet, responded that Genesis had, quote, submitted a proposal on December 19th and had not received a response. Now, the next deadline for an agreement is set for January 8th, which is this coming Sunday. And any headline around this could move crypto markets. So do keep your eyes peeled for any of headlines around that front, as it could move crypto markets. Now, as always, we wrap up with a summary of the events and data that could move the markets in the week ahead. And on Wednesday, as we mentioned, at 10 a.m. Eastern, we got U.S. job openings. Estimate here is for 10.1 million, down from last month's 10.3 million. And this is trending in the right direction, as we mentioned, that the Fed wants to see. However, like we said, there's still a lot of room, or a lot of slack, if you call it, in the U.S. Labor market. It's well, not slack. It's actually very, very tight. There are not enough people, effectively, to take on the job openings that are in the U.S., which makes it very difficult for the Fed to basically put pressure and slow down the economy, because everybody has a lot of job certainty. Now, at 2 p.m. on Wednesday, we get the FOMC meeting minutes from the December 14th meeting. And again, the implications of that, we just covered. Any potential views that are communicated from the minutes that were not shared in the press conference could potentially move markets. Now, on Friday at 8 a.m. Eastern, we get non-farm payrolls, which is new non-farm employment in the United States. Expectation here is for a new 180,000 jobs created, down from 262,000 in November. But again, trending in the right direction. We also get the U.S. unemployment rate at 8:30 a.m. on Friday, and the expectation is for this to come in unchanged from October at 3.7%. So any move or change here could also potentially move markets, but again, that unemployment number is still too low for the Fed to be worried about. So with that, we've reached the end of today's show. If you enjoyed the show, I welcome you to like it, share it, subscribe to our channel. Please leave us your comments and feedback and questions you would like us to cover in the next issue. And if you don't yet have a Ledn account, I welcome you to check us out at ledn.io. Thank you, everybody. Have a wonderful week, and see you next Tuesday.